That is the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade. Let's see where the major averages did end up here. It looks mixed. The Dow looks like we're going to be down about 520 points. We know a lot of that pain coming from UnitedHealth, which cratered in today's trade after an earnings miss. Looking at the other, its peers here, the other popular averages, the SPX, the S&P 500, your broad gauge, is going to finish up about 0.1%. And meanwhile, the tech-heavy NASDAQ, that looks like it's going to finish down about 0.1%. Now to Jared for a closer look at today's sector action. Jared.
Thank you, Josh. Let's take a look at the intraday price action, then we'll take a look at the week. Here is the Dow. You can see it spent the entire day underwater. Indeed, that UnitedHealth scare, I guess, is weighing down the entire index right now, as it's one of the highest priced members of that index. But let's take a look at the 4-day look here. We can see the Dow down 2.66% over that time. NASDAQ down as well. Let's check out those totals. That's coming to about the same number, 2.6%. S&P 500, which was up today just slightly, down 1.5%. And then the Russell 2000 is up 1.2% over these 4 days. And we also were up last week. So that's 2 weeks in a row for the Russell 2000. The comps this week are really not that interesting given the outsized volatility that we've seen in each of the 2 prior weeks. So this is the sector action today. You can see energy was up over 2%, so is consumer staples. Then we have real estate, utilities, materials, and consumer discretionary rounding out the top rows. What didn't work today, healthcare and tech. Those 2 down about 0.5% apiece. And we'll also take a look at the 4-day look where you have kind of a split field. We got real estate up 4%, energy up 3%, and then tech down almost 3%. So is consumer discretionary. So really the mega cap sectors, and that's really what we're looking at here in the NASDAQ 100. Those were some of the weakest issues, and you apply that with the market cap weighting, no doubt that's why they were dragging down some of these indices. Meanwhile, those small caps were higher on the week. So Microsoft down about 5%, Nvidia down over 8%, Amazon 6%, Meta almost 8%. Some fairly significant losses there again, but take a look at some of the smaller issues there. There is a decent amount of green on the screen, so it's not necessarily broad-based. And we can also see this if we take a look at, let's look at the ARK Innovation Fund here. We got a couple winners here, Beam and Roblox, but unprofitable tech, not really rounding out the week well. Send it back to you, Josh.
All right, Jared, thank you. First quarter results for Netflix, they are just hitting the wire now. Let's take a look at those numbers. Q1 EPS, $6.61. The street was looking for $5.68. Q1 revenue, $10.54 billion. Consensus was $10.5 billion. I'm just looking for Q2 revenue, $11.04 billion. The street was at $10.88 billion. Q2 EPS, $7.03. The street was at $6.24. Looks like they're saying revenue is tracking above the midpoint of that 2025 forecast. At least the initial reaction here, we're up about 0.4%. Of course, keep in mind the stock was up about 60% over the past 12 months. But Allie, what are you seeing so far in the numbers?
I mean, really strong guidance here, seeing Q2 revenue significantly above the estimate. Also, the fact that they're reiterating their prior guidance for revenue and also our operating margins is encouraging, especially since we've been in this moment where there's a lot of uncertainty. Netflix, though, has been one of the names that have been viewed as more of a defensive position due to the fact that they are not as exposed to some of the advertising headwinds that you can get with some of those other legacy media and big tech companies. So companies like Paramount, Warner Brothers Discovery, they could actually do worse in this environment. See, even with a company like Meta, one of those Mag 7 names, very, very exposed to advertising. Netflix is sort of in that sweet spot where they're not dealing with that. So we have this reiterating of the guidance. We have a beat on the top and bottom lines. If you take a look at shares, they're up marginally in after hours trading as investors assess this report. We do have a stock that potentially has more room to run. Analysts across the street consistently see this stock trading above $1,000 a share. There have been rumors when you think about a potential stock split for a company like Netflix. So that's something that we'll listen out for on the call, and really just further commentary on their live events, on their product rollout. Now that they're no longer reporting subscriber figures, what is going to be the emphasis on this call? But all in all, a very solid report from this company.
Yeah, it certainly looks like it. And I think probably what we're seeing here here is the stay-at-home trend. The broad-based discretionary spending may be cutting back, but when it comes to paying $10 a month, a little bit more to get those ads out of the way in order to enjoy Netflix and chill, that's what we're getting. At least that's what the numbers suggest. Anything under the hood that we can see in terms of what's driving that beat?
Yeah, I mean, they did say in Q1 they had a lot of solid content. Adolescence, that's actually a show that's from abroad, which stands out to me when it comes to the global appeal of Netflix. They're not just focusing on US-based shows, they're also focusing on content overseas. So all of that is contributing to this Netflix flywheel effect. So they're saying they're continuing to build out their live offering. They had the launch of WWE Raw. They've been asked before on these calls whether or not they're going to bid on UFC rights. Maybe that'll come up again today when we think about sports and the opportunity there. But they did say in the release, our revenue and profit growth outlook remains solid. Again, no change to that 2025 guidance.
All right, thank you, Alan. Appreciate it. Well, joining us now in studio is Jeff Blazek from Neuberger Berman, where he serves as multi-asset chief investment officer. Jeff, let me get your take on this. We just have Netflix crossing the wires here. I'm curious, beyond Netflix, we've heard from the big banks. We got Netflix, of course, big tech is on deck. So far, Jeff, how would you characterize this earnings season? What have been your big takeaways?
Yeah, well, first off, thanks for having me. And this is the nitty-gritty of where we roll up our sleeves and really see how subsectors and individual companies are behaving in this environment. And so far, the historical results are solid. I mean, we're seeing, there are certainly some exceptions, but by and large, numbers have been consistent. But of course, the guidance is that open question. And I think it was particularly interesting when United Airlines a couple of days ago had dual tracks of if recession, if not recession, this is what we project. And in some cases, management teams are just saying, look, we have to be opaque because the environment's opaque. So, I think it's about what we expected. And clearly, though, the reported numbers of 1Q are going to be ancient history and really are not going to be what's driving the market in the near term.
So how are, you're reading all these earnings reports, and how are the companies, other than the guidance element, from an operational element, how do you deal with the fact that tariffs could be 0% one day, 25% the next, 0% the next? How are they managing through this, particularly those areas of the market that are more affected? Places like Netflix are pretty insulated from what we're seeing, or even the big banks, the bank day, reports. They're not really directly affected by the tariff policies, and so really where the uncertainty is, the big industrials, consumer companies, et cetera. How are they positioned through this difficult environment?
Yeah, I think your prior guest articulated it well, which was the concept of agility, that you want to really be balanced towards multiple scenarios. The reality is, in the old days, we used to look at strength of balance sheet and a lot of other ways that quality was informed, margins. Now it's supply chain and whether or not you are tied to a certain country on how you source your products. But even then, we don't know the ultimate outcome on tariffs. So I think the agility, shoring up liquidity, those are the things we're looking at from companies. And certainly we are looking under the hood to understand their end consumer, how they're doing. But again, we're seeing that same wait and see mode. And there's just, unfortunately right now, there's a lot of different paths this can take. And so staying agile and flexible until we have a lot more clarity is the key for most companies.
And any place that you're looking at that looks particularly robust relative to other areas of the market when it comes to that ability to be agile?
Well, I won't comment specifically on sectors, just to say value in general, lower multiple stocks. One theme that we've had really for about 5-6 months going into last year is a broadening out concept. So we had thought the Magnificent Seven had gotten priced to perfection. They were at earnings that were at 30x or sometimes higher than that. And we thought that the broadening out, there would be a compression between the run rate of those two growths, the other 493 and the Mag 7. And indeed, that's played out pretty well. So we think in an environment like this where there's uncertainty, you want to protect yourself with lower multiple stocks. And value has been working very well as a factor as a result.
And Jeff, I know you talk about sort of leaning into what you call first principles of investment when you're kind of, as an investor, trying to navigate a very volatile environment. Talk about those first principles. How do you define first principles?
Yes, so at Neuberger, we do have a lot of tactical things that we do with portfolios with smaller parts of the portfolio. We have strategic asset allocations, though, for our multi-asset clients, where we want to make sure that we're building a portfolio that can really survive all types of conditions, whether it's deflationary or inflationary, value versus growth. So diversification to us is the key first principle. The other thing we would say is don't abandon your equity orientation in a market like this. Have discipline when you rebalance. And just know that this is impossible to handicap. This is really the first market mini crisis, hopefully not a full-blown crisis, where it's being controlled by policy decisions of a select group of individuals, not from exogenous shocks or other market drivers. So with that being unknown, we think you have to be diversified across a wide variety of scenarios, and that's really the most important first principles.
And so if you're thinking about, this is certainly an uncertain environment, and even not just economically or from federal government policy, we've now got a real question about whether Fed independence is going to be called into question.
Yes.
How do you, in your seat, look at that question in the context of creating a robust portfolio that can withstand a wide variety of circumstances?
Yes. First off, the independence of the Fed is crucial for our capital markets, and we certainly hope that will remain the case. In terms of the way that we would position portfolios around that, I think it's consistent with another theme we've had, the broadening out in equities, but in fixed income, it's been around the concept of steepening. And in part because of the fact that fiscal pressures, the deficits that we're incurring, and the likelihood they will continue to rise meant that term premium on the 10-year and the 30-year was going to increase. If we do have what I'll call a meddling of the administrative branch into the independence of the Fed, presumably they're going to want to cut rates. Trump has been very outspoken about that. And so that will pressure the front end downward in a favorable way for policy rates. But it will probably cause the longer end to be stable, if not increase higher for more term premium. The fact that this is a new development, it could be destabilizing at least for a short period of time. And so steepening yield curves are things that we think investors need to be prepared with. And it's been something that we've been protecting our fixed income portfolios for.
Jeff, great to see you, to have you on set today. Appreciate it.
Great. Thank you very much.
Coming up, we are just getting some analyst reactions to the latest earnings results from Netflix. Netflix, stick around. Much more market domination overtime. That's still to come. Netflix top at earnings expectations for the first quarter. The streaming giant also maintaining its 2025 revenue forecast. For more on the road ahead for Netflix, let's get to Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan. Geetha, it is good to see you on the show, as always. So Netflix reports, Geetha, stock is up now 4.5% in the after hours. But walk us through your reaction to the results. What do you make of the print?
Yeah, thank you so much, Josh. So this is the first time that Netflix has actually not reported any subscriber numbers, which is really, very, very different, feels very different. But financial targets came in well above expectations. This was really, again, one of their blockbuster quarters, I would say, because one of the things we were thinking about, as we kind of approached this quarter was they did have a lot of price hikes that were implemented in January. And so the concern was whether there would be a revenue slowdown if people were in fact churning and canceling subscriptions. But looks like revenue growth actually came in higher than expected. So that's pretty good news. And what they said is that they're actually implementing more price hikes. I think they mentioned France and some other markets. So again, gives you confidence in kind of their pricing power and their strategy going forward. And again, if you look at some of the guidance that they've issued for revenue growth in Q2, again, more than 15% growth, really strong. And then they reaffirmed full year financial targets, which, in this environment with so much of uncertainty, with an impending recession is really, really good news and just gives you a lot of confidence in the momentum and the way that the management team is executing.
So obviously a great quarter when it comes to continuing to raise prices. Any perspective on how the advertising segment of their revenue is going?
Yeah, so they did say that they've taken a lot of steps. Advertising is still a very, very nascent business for them, but they are taking steps to ramp that business up pretty significantly. So the targets for this year is that they are going to double their revenue from last year, which we estimate was about 1.2 to 1.5 billion. But more importantly is the fact that they've actually laid out targets in a 5-year plan. So for 2030. They expect to hit $9 billion in advertising revenue, which would be almost 12% of their total revenue, up from about 3 to 4% today. So advertising is definitely going to become a more and more important part of the whole, Netflix business model. They're doing a lot of different things to really build the business. So one is investing in programming that really plays well to advertising. So you talk about sports, you talk about live content like WWE Raw, like some of those NFL games, and they're investing in that, and they're going to continue to do that, I think, in a pretty big way. And then the other thing is really kind of building their own infrastructure. So on April 1st, they actually launched their own Netflix ad exchange within the US, and that's going to help them sell more ads and do it in a very, very efficient way as they improve and open up their ad inventory across to many, many different platforms. So they're really taking steps to build the business, and I think it's going to become a major revenue driver starting in 2026.
Geetha, if we were to see a material economic slowdown in the US, how would that impact Netflix? We've had some analysts come on, Geetha, and suggest that if that were to happen, they would see Netflix as a kind of relative defensive play, relative safe haven, but how do you see it?
I see it exactly the same way. I think Netflix actually benefits because just think of it, Josh, if you're not going to go on that expensive vacation, what is your alternative? You're going to have a staycation. What are you going to do? You're going to watch more Netflix. So if you really look at Netflix as a form of entertainment and compare it, just think of a movie ticket. The price of a movie ticket in New York today is like $20, $25 for one person for entertainment for about 2 hours. With Netflix, you're either paying $18 or $25 without ads for a whole family for a whole month. So this is really one of your cheapest forms of entertainment. And we've seen time and time again that in a recessionary environment, people actually consume more streaming content. They consume more TV content. So we actually think Netflix is well positioned should we get into like an economic downturn or a recession.
Obviously, with the beat, the top line is continuing to power the earnings forward. Any perspective on the spend related to content, particularly as they're bringing on some of these, higher ticket live events in the coming months and years?
Absolutely. So yes, you're absolutely right. That top line is going to be growing double digits, probably almost 12 to 15% this year. The idea with the whole operating leverage in the Netflix model is yes, the top line grows. Yes, content spend will also grow, but content spend is going to grow at a lesser rate than the top line, which is what gives you the operating leverage, which is what takes us to margins, expanding margins. We know that last year Netflix expanded margins by 600 basis points to 27%. This year they've reaffirmed their target for 29%. But if you just look at the 2Q guide, for instance, it's 33%. I mean, this really speaks to the amount of control that they have in terms of costs. So yes, they're going to spend, but it's still going to be very, very disciplined and in a very, very focused way, so that they're still able to have a lot of leverage in terms of pushing up that operating margin.
Geetha, the Journal reported leaked targets from the company, which were impressive, including, they said, 110 million net ads over the next 5 years. What did you make of that, Geetha? And where would those kind of net ads come from? Would that be ad-free, ad-supported, certain regions? Where would you be looking for the growth?
Yeah, absolutely. So Netflix kind of giving those numbers just tells us that they still do see a lot of runway when it comes to subscriber growth. So right now we know that they have well over 300 million subscribers, but they've identified a global opportunity, Josh, of 750 million broadband households. So they obviously still have a long way to go. And just the fact that they gave us that 410 million obviously suggests that they think they can easily get about 18 to 20 million new subscriptions every year. Now, you look at even a market like the United States, this is a very, very highly penetrated, highly saturated market. But even in the US, last year, Netflix actually added 10 million new subscriptions. So, they're using different combinations of strategies. Who knows, maybe they introduce more different tiers coming in at different, price points, appealing to different segments of the population. But yes, if you just kind of look at it from a global perspective, we're going to see growth coming more from, I think, the Asia Pacific region, where penetration is generally a little bit low for Netflix, more from EMEA, where again, also penetration is a little bit low versus the US, which is almost at about 65%. So it's going to be pretty balanced, I think, across the globe.
Geetha, always a pleasure to have you on the show. Thank you so much for joining us and for that instant analysis and reaction. We appreciate it.
Thank you.
Well, with uncertainty remaining, the word on the street, volatility has entered a new phase. So how should options traders tackle the shifting rules of the volatility game? Baycrest Managing Director David Boole joins us now for the Options Playbook, sponsored by Tasty Trade. David, it's great to see you. So you say here, David, VIX 30 is the new 20. What do you mean by that, David? Walk us through it.
Well, investors have gotten very comfortable over the last year, really since COVID, that VIX kind of stays in this range in the mid-teens. And then if there's some sort of a panic, some sort of reason for risk off, it spikes above 20, sometimes gets to 30, sometimes even higher. But then the sell-off is as severe oftentimes as the spike higher. We saw that in August of 2024. This is different. I would compare this more so to the COVID shock from a volatility perspective, where you get the big move up through 30, up into 40s, and then we just kind of have a new baseline. It's very similar also in that there's a lot of headline risk in the market, where we're trading off of, obviously, Trump tweets and posts that he puts out. Similar to COVID, where it's just any news article can move the market. That's almost more important than the actual economic data and earnings. We saw Netflix just now was moving just 5% after its earnings report. That's a little less than what earnings were anticipating for that move today. So, but a Trump tweet over the weekend could move markets much more. So when I look back at what VIX did during COVID, it stayed above 30 and really didn't get back below 20 until an entire year from the initial spike. I think investors are just going to get used to this VIX around 30 range, which implies about a 2% move every day. And that's kind of what we've been seeing in April. And I think that's here to stay. It's not it's a new regime that we're in.
So as we sit in a higher volatility environment, maybe structurally, at least for a little while, where are the opportunities that you see in the market to take advantage through options?
So I've heard clients tell me the VIX is a little bit in no man's land right here. It's at 30, so it's, if many had a time machine, they would love to go back and buy a lot of option premium when VIX was 15. But now that options are a little bit more expensive, I see clients, some of them are a little bit frozen, where they're saying, wow, hedges are a little bit too expensive to buy up here with VIX above 30. And also, many are petrified to sell vol, to fade it going lower. I disagree. I think there's opportunities on both sides. If you get a little bit more clever with how you structure the trades, I think you want to play a range on either side. And you can use some of that expensive volatility in our favor when we structure positions, all while keeping it limited to the premium spent. That's very important. I'm not suggesting that you sell a VIX 40 strike call and have the risk, a blow up risk out there. But I'm seeing folks look to fade volatility back into the lower 20s, mid 20s, lower 20s with put flies on VIX. I think those are interesting. And I also think there's range bound trades to still put hedges on here where you can get paid 5, 6, 7 times your money in a very realistic range.
David, spinning ahead, Tesla earnings on deck next week. Is there a trade there, David, to walk us through?
Tesla's really interesting. Speaking of trading in a range, it's been in its own Tesla range, which is about $50, either maybe $60 either side of 240, where it closed today. Sentiment's pretty horrible in Tesla, especially where I am out here in California. And I feel like a lot of bad news may be priced into the stock. And it's come down from 500 to 240. I saw an interesting call spread play a potential move back up to the high end of the range earlier this week. So the trade that I would put on to benefit if the stock does go higher is the April 25th, next Friday, 265, 285 call spread. You're risking about $2.75. It's not much premium to be able to benefit from about a 7 times your money payout. If the stock goes back higher, that's about, you get exposure to up 10, up 20% range. So while the stock has been lower 5 of the last earnings prints, when it goes up, it really goes up. So there's been an up 20% move, an up 12% move, et cetera. So if you think that earnings next week are a little bit of a coin flip, I like taking that coin flip and getting paid 5, 6, 7 times my money if that payout hits.
David, great to see you and to have you on the show today. Thank you.
Thank you.
Time now for what to watch next week. We're going to start off on the earnings front. The Magnificent Seven is in focus next week with earnings coming in from Tesla and Google parent company Alphabet. Tesla announcing results for the first quarter after the markets close on Tuesday. Analysts expecting Q1 to mark the bottom for Elon Musk's company with recall and protest headlines signaling a tough first quarter. Yahoo Finance is going to have a special coverage of all things Tesla on Tuesday with coverage starting at 4 p.m. Eastern. Now, taking a look at the Fed, we're going to be getting a big batch of commentary throughout the week from Fed officials. This is coming after a sharp sell-off yesterday following comments from Fed Chair Jerome Powell. Powell saying that the effects of tariffs are moving the Fed away from its dual mandate goal of price stability and maximum employment. And moving over to housing, some fresh housing data coming in on Wednesday with new home sales. Economists forecasting sales to increase to 683,000, which would make it the third straight month of gains. That's going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. We've got you covered for the next half hour with the latest and greatest market move stories so you can get ahead of the themes affecting your money. Stay tuned.